I think that gold's going to turn around. I think in the near term, what we've got is we've basically got a little bit more consolidation. I think that, 1900 is kind of the level that we're watching right now. I could fully see it going down to 1850. I do not expect it to go below that. That would also line up really nicely with the 40-month moving average, which by the time it got there would be around 1850. But I think that's going to be probably a really, really good entry point. I think that silver could touch this trend line. If it does, I think that'd be another great entry point. But there is some real downside risk to this going down to 18 or so.
Gold prices edged higher on Tuesday, supported by a retreat in the dollar and bond yields as investors awaited U.S. inflation data that could provide further insights into the Federal Reserve's rate hike trajectory. Steve Barton, a gold analyst and trader with over 20 years of experience, believes that gold will likely rebound soon. He anticipates some consolidation in the market and currently observes a price level of around $1,900. While he mentions the possibility of gold declining to $1,850, he doesn't expect it to go below that level. Regarding silver, it may approach a trend line, presenting another favorable entry point. However, he acknowledges the existence of downside risk, with silver potentially dropping to $18. Gold is often considered a safe haven investment during political and financial uncertainty. However, higher interest rates increase the opportunity cost of holding non-yielding assets like gold. Barton points out that 92.4% of knowledgeable traders anticipate a 25 basis points hike in the upcoming July 26th meeting. This situation is unfavorable for gold, as higher interest rates on treasuries and bonds become more enticing alternatives. During the interview with Liberty and Finance, Barton also highlighted that the DXY, which represents a basket of currencies including the euro, yen, and British pound, has performed better than expected. The recent interest rate hike by the European Central Bank, ECB, is likely to strengthen the euro against the dollar. Higher interest rates make a currency more attractive to investors, as it offers the potential for higher returns. Consequently, a stronger euro could limit gold's potential gains, as it would become more expensive for investors holding euros. Now watch clips from Steve Barton's interview with Liberty and Finance. Please watch the entire video and consider subscribing to our channel. Remember to turn on post notifications so you get all our uploads. Thanks and enjoy the video.
What's really interesting here for gold is last time we were on the show, we were up around 1980, I believe. And we saw gold coming down. The next level of resistance after that was 1950 and then 1900. Well, we've touched 1900 and just kind of been trading right along this trend line right here. I'm sorry, this moving average. But if we go back to this triple bottom right here at 1615. So we hit it once, twice, and three times. And what's interesting about this third time right here was this bottom on November 3rd coincides perfectly with the Fed funds rate and when they did a hike. So if we go here to November 2nd, okay, they raised 75 basis points. And Jerome Powell was talking at that time saying that, he could see the Fed slowing the rate of increase, raising just a little bit less. Well, gold sniffed this out. So this was November 2nd, and we can see that gold sniffed this out the very next day on November 3rd. And after that, we've just been in a gradual trend up. So gold kind of sniffs this stuff out ahead of time. And I think they're going to be doing the same thing here. The Fed is going to be increasing some rates, it looks like. I mean, if we go to the Fed Watch tool and we take a look at what they're forecasting. So the smartest traders in the world, 92.4% of them as of the time of this recording, believe that they're going to raise another 25 basis points on their next July 26th meeting. Now, if we go out on each one of these after that, the bond traders don't think that they're going to start cutting until May 1st. Not great for gold, right? If you have if they're going to be giving you a bigger interest rate on treasuries and bonds, then there's no real reason to hold what Warren Buffett would call a pet rock that doesn't pay you anything. People can put their money into money market funds, they can put them into treasuries, and they can get a real return on that, something that's guaranteed. You can't necessarily do that from gold. But we can also see that gold sniffs this out before it happens, just like it hit the bottom when the Fed didn't even pivot yet. They just simply stopped increasing the rates quite so rapidly. And that's when gold hit a bottom. The Fed could continue increasing interest rates. They could do that. I mean, Jerome Powell's got his foot on the gas and he doesn't seem to be taking it off. So that wouldn't be good. The DXY has been holding up better than I thought it would. We're at the day right now, I think we're at 102 or 103. The European Central Bank is increasing their interest rates. They just had another hike a couple weeks ago. So basically, the way the DXY works is, it's a conglomeration of currencies that we it's just fiat currencies being compared against each other. And in the DXY, you got 58% in the euro, 13% in the yen, 11% in the British pound, and as those currencies become stronger, then the dollar will become weaker and vice versa. So since they're still increasing their rates, that's, it's not great for gold in that. We kind of need the dollar to drop down, and then it will take more of those fake fiat dollars to purchase real money, gold.
Regarding silver's price movement, Barton believes it is currently trading slightly above $23 and predicts it will likely close the week around that level. He acknowledges the presence of significant resistance above silver, indicated by multiple moving averages that need to be surpassed for it to break above $24. However, Barton also highlights the downside risk for silver, stating that there is a possibility it could decline to around $18. According to Barton, tech stocks have a significant bubble, especially in the S&P 500. He points out that only a few companies, including Nvidia, are responsible for supporting the entire market. Despite his skepticism about the market's strength, Barton expects it to continue rising as long as speculation persists. However, he predicts that all assets, including tech stocks, will experience a sell-off in the event of a recession. He also suggests that gold and silver, despite a temporary decline, will recover more quickly than the overall market. Let's now get back to the interview.
We'll pull up silver. We're just north of $23 here. We're probably going to close out the week at that. We got another hour and a half of the markets being open, but I think it'll hit about that. We've got some real resistance above silver here. I mean, you can see all these moving averages. It's got to get through to break up north of 24. But if you look at this long upward channel right here, right? So this was the November 3rd in silver, and you remember what that was like in gold. That's darn near a bottom. I mean, it's within a buck or so. I think that silver could touch this trend line. If it does, I think that'd be another great entry point. But there is some real downside risk to this going down to 18 or so. I don't think it'll break this channel, this trend line here. But if it does, as Rick Rule says, that would be a back up the truck moment. I think right now we got a real bubble in the tech stocks. So basically the S&P 500, there's about 7 or 8 companies that are holding the whole thing up, right? A lot of these AI technology companies, NVIDIA is a great example, okay? Right now their share price is $430. Their PE ratio is 219, okay? And their dividend is 0.04%. So to put that into perspective, for every $430 that you invest per share, you're going to get 16 cents per year on that. Now, compare and contrast that with maybe an oil royalty company like Blackstone Minerals. They have a share price now just south of $16, and they're paying a 12% dividend, which for every 16 bucks you put in, you get about $2 a year for it. That's a lot better deal. I get questions all the time. In the last month, I've been asked more questions about tech stocks than I've been asked about stocks, period. So if that doesn't define a bubble, I don't know what is. I think basically, if we go back to the chart of the S&P 500 here, I don't know how much longer we can last in clown world. I got to believe that, this is just unbelievable. I've been floored by the strength of the market, but as long as we're still in clown world, just like we were back in the .com bubble, I don't see the brakes getting put on this anytime soon. I really don't. This is super bullish. I mean, it wouldn't surprise me at all if we take out these two. It just basically turns on it. Like once the recession starts hitting, everything gets sold. This is going to get sold. Gold and silver for a hot minute will get sold, but that'll be the back up the truck moment because they're going to recover far faster than the general market.
Gold prices will likely increase soon, but rising interest rates and a stronger euro could cap them. When interest rates go up, it becomes more expensive to borrow money. This makes non-yielding assets like gold less attractive, as investors can earn a higher return on other assets such as bonds. The euro is the currency of many European countries, and it has been gaining value against the dollar in recent months. This makes gold more expensive for investors who hold euros. Will rising interest rates and a stronger euro significantly impact gold and silver prices? Please share your thoughts in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.